Hey guys, Nathan Sprague here with Guardian Financial Group. In this video, I'd like to go over a hot topic here of late, especially over the last few years, and that's something known as the infinite banking strategy or infinite banking concept. And in this video, I hope to kind of explain what it is and how it works and maybe why perhaps you should care. So without further ado, let's dive right in here. Put together a few bullet points here to start before we kind of dive into some illustrations and some numbers and further explaining how it works. But first and foremost, what is the infinite banking concept, or as I'll refer to it as we go on here, IBC? To be honest, it's nothing more than a marketing ploy. So this was, I say the concept was developed by a guy named Nelson Nash about 20 years ago, but really the concept wasn't developed by him. It was really just him labeling a concept that has been in place for many, many years as infinite banking. And over the last 10 or 20 years here, this has been referred to as a lot of different things. For example, bank on yourself, private family bank, be your own bank, your family bank, et cetera, et cetera. So people have been using these types of names over the years, but it's essentially referring to the same strategy that has been in place for literally centuries. So that's all it really is, but at a high level, it's a specialized form of permanent cash value life insurance that is typically whole life insurance. It can be other products, but in most cases, it's whole life insurance. And it gives you the ability to act as your own bank by self-financing purchases or investments to either save money or improve the rate of return on those investments. And again, at a very high level, it essentially allows you to build your own self-serving line of credit and allows you to essentially what's been referred to as this concept has kind of been marketed over the years as the ability to quote unquote use your dollar twice, which allows you to grow and compound your money while simultaneously using that same money to self-finance purchases and investments. So in essence, using your dollar twice. So diving further, what constitutes life insurance as infinite banking? First and foremost, it has to be permanent cash value life insurance. As I said, it's typically whole life insurance. It could also be something referred to as IUL or indexed universal life. There are some caveats with IUL, and we'll kind of dive into that in other videos, but for all intents and purposes and for the sake of this video, we're going to be talking specifically about a specialized type of whole life insurance. That policy and that product and this strategy provides a permanent death benefit while also at the same time building tax-free cash value inside of the policy. In order to qualify as what we would refer to as an infinite banking policy, it has to be written with a mutual company, which means these mutual companies pay profits to their policyholders rather than paying profits to shareholders. So you as a potential policyholder are in essence a shareholder, and thus you are paid dividends, so you are paid profits in the form of dividends as a policyholder. These policies typically provide right around a 4% guaranteed rate of return on your cash value inside of the policy, plus the dividends that they pay. And the companies that qualify and kind of check all the boxes here that we're typically going to be writing these policies with have paid dividends every single year, many of them for over 100 years consecutively. So those dividends typically amount to an additional 1 to 2%. So really effectively, you're looking at growing your cash value at a real rate of return in the range of 5 to 6% year after year after year, like clockwork. So in addition to that, they offer these policies that are classified as infinite banking strategies and infinite banking policies offer what's called a full participating loan feature, which gives you, that's really where the magic happens in all of this, is that it allows you to take out loans against the cash value in your policy without interrupting the growth and compounding of that cash value in your policy, and thus enabling you to, quote unquote, use your dollar twice. And then finally, with these policies in this concept, design and structuring is key. So how the policy is designed can make all the difference in the world. First and foremost, not all products are alike, but even two identical products from the same carrier can perform very, very differently if they're designed in different ways. So in order to classify as what we would call an infinite banking design, there are some critical and important design elements that need to be met. Diving kind of further into those design details, it really means that you're allocating the minimum amount of your total premium dollars towards the cost of insurance, which is essentially going to purchase the death benefit. So for example, if you were contributing, let's say $1,000 per month into your infinite banking policy, you would want to allocate the least amount of that $1,000 towards the cost of insurance and purchasing the death benefit. And there's actually a limit that the IRS has defined in their tax code. It's tax code 7702, that basically says, there's a cap on the maximum amount of dollars that you can sort of overfund a policy with, that you can put additional dollars towards cash value above and beyond your cost of insurance until you hit this limit, and the IRS then deems the policy as what they call a modified endowment contract, and it loses all of its tax-free advantages. So with an infinite banking design, you want to push right up against that limit and essentially, again, allocate the minimum amount of dollars towards purchasing the death benefit and the cost of insurance, and putting the remaining majority of your total premium dollars towards what's called paid up additions. And those dollars go directly to your cash value, and that's what's growing at the guaranteed 4% rate of return plus your dividends. So effectively, call it 5 to 6% like clockwork. And this provides you very, very safe and very, very predictable growth of your money. Again, it's inside of a completely tax-free vehicle, and the performance of this policy is not dependent on the stock market or the economy in any way. So, if we were to see another 2008 type stock market crash, or 2020 coronavirus type stock market crash, your policy isn't going to miss a beat. You're going to continue churning out those 5 to 6% type of returns on your cash value year after year after year like clockwork. So that's a little bit about the design. In terms of benefits of the overall strategy itself, as I mentioned, it provides a tax-free savings vehicle with very predictable growth. If anything were to happen to you, it obviously pays a death benefit, which is also tax-free to your beneficiary or beneficiaries. Tax-free dollars to help support them in case of your absence, if anything were to happen. The other thing is that there are zero restrictions on these types of products and this strategy. So if we think of other, kind of tax-free strategies, oftentimes people think of something like a Roth IRA. And a Roth IRA, if you're contributing directly into a Roth IRA, that there's a lot of restrictions. There's income limits. So if you make above a certain income annually, you can't contribute any amount of money to a Roth IRA. And there's also contribution limits. So even if you're under the income limits, you're capped at the maximum amount of dollars that you can contribute into the account. And at the time of making this video, I believe that's currently for an individual around $6,000 a year. So, there's only so much you can do and so fast, or there's only so much money you can put into an account like that to get your money growing at $6,000 per year. Well, with the infinite banking strategy and this concept, there are zero restrictions whatsoever. There's no contribution limits and there's no income limits. You could be earning $10 million a year and still contribute into a strategy like this. And there's no contribution limits. If you wanted to contribute all 10 million of that every single year, you could do that with no restrictions and no limitations whatsoever. In addition to that, you have access to your cash value anytime you need it or want it for literally anything you want. Unlike a Roth IRA or your 401k or other tax deferred type saving strategies, you don't have to wait till you're 59 and a half to access those funds or be assessed any sort of penalty. Obviously, because it's tax free, there's no tax consequences for early withdrawals. And as I mentioned, it's literally for anything you want. There's no, it doesn't have to be for the purchase of anything specific. You could take that money out to go on vacation if you want. And in addition to that, you determine the terms of the repayment on the policy loan. So when you build cash value inside of the policy and you want to take a policy loan out against that, you determine your repayment terms, if you even want to repay it at all. It's your money, so if you don't even want to repay the loan at all, you don't have to. But if you do, you can elect to make any sort of repayments however frequently or infrequently you like. So that's completely up to you. You have total flexibility there. And then, ultimately, as we mentioned, it allows you to effectively operate as your own bank to save money through self-financing purchases or improving returns on investments. So to kind of further explain how this strategy can operate effectively as your own bank, kind of give some high-level details about how banks operate. So I've got listed here Banking 101. How does a bank work? How does a bank make money? Well, first of all, you give the bank your money. In return, they typically pay you a very, very low interest rate for giving you their money, oftentimes less than 1%. If you're even able to earn 1%, in my opinion, that's pretty spectacular. And then what they'll do is turn around and lend your money to other borrowers and charge them anywhere from 3% on the low end for something like a mortgage to as high as could be like 25% for something like a line of credit on a credit card or anything in between. So banks make their money, they make their profit on that arbitrage spread between those interest rates. If they're paying you 1% to effectively borrow your money and then turning around and lending it to someone else for 5%, say for example, they're making money on that 4% spread. And with the infinite banking concept, it allows you to collect that arbitrage spread of interest through the participating loan feature in your policy, thus effectively acting as your own bank. And this will probably make more sense as we get into some numbers here and draw out some illustrations. But before we do that, just some examples of how you could use the infinite banking concept. You could self-finance the purchase of a car. You could self-finance a down payment on a home. You could self-finance your kids' college tuition. You could use it to pay for a home renovation project, purchase a rental property if you're looking for something like an investment. Could be an investment in a business that you own, or go on a dream vacation. It literally does not matter. There are no restrictions whatsoever. It's not just limited to these things that I've listed, and it's not limited to any number of times you could borrow against your cash value, as many times and as frequently as you like. No restrictions whatsoever. So having said that, let's dive into some numbers. And I want to compare how this strategy works compared to other traditional strategies, primarily paying cash or traditional financing. So the first thing I want to do here is just kind of pull up a little whiteboard here. And I want to first explain that, if you were to look at, let's use an example of purchasing a car. And you have to forgive my bad mouse penmanship here, but let's say you purchased a new vehicle for $40,000, okay? Well, you've got traditionally kind of two options to do that. You could pay $40,000 cash for the vehicle, or you could finance the vehicle. So looking at the scenario where you paid cash for the vehicle, you pay $40,000, the vehicle is yours. You obviously don't have any debt service on the vehicle or pay any interest, but that $40,000 is no longer working for you. It's, whatever account you took that out of, it no longer has any interest earning power. So you really have a lost opportunity cost in that $40,000 is no longer able to work for you. And then in addition to that, if you're like a lot of people, if you want to buy a new vehicle a year from now or 3 years from now or 5 years from now, and you know that you don't want to finance it and you want to pay cash for the next vehicle, you have to start socking money away to save for the purchase of that next vehicle. So it's really almost as if you still have a car payment, even though you paid cash for the vehicle. And in addition to that, as we mentioned, you miss out on the lost opportunity cost of what that $40,000 could have been earning you and is no longer able to do that. So that's the cash example. The financing example is probably most familiar. If you finance a vehicle, let's just pretend that you didn't put any money down and you financed the full $40,000. Well, you're going to pay $40,000, the principal amount, back to your lender, but you're going to pay that plus interest, whatever interest they're charging you on that over time. So, let's just say for the sake of argument that it ended up being over a 5-year term. Let's say you paid a total of $8,000 in interest. Well, you effectively paid $48,000 for that $40,000 vehicle. So that's kind of the traditional method. And then you have infinite banking. So if you were to structure an infinite banking policy and essentially operate as your own bank and self-finance the purchase of that vehicle, I want to show you, what can happen and kind of the magic of this whole strategy. So I'm going to draw a graph here. Again, I apologize for my bad penmanship here, but let's say this is a graph of dollars on the vertical versus time on the horizontal here. And let's use this same $40,000. So if you were to structure an infinite banking policy and you had at least $40,000 of cash value inside of the policy that you were going to borrow against to self-finance the purchase of this vehicle. The beauty is, and let's, whoops, that's not a very straight line here. Draw a line here and say, okay, this is your 40K that you borrowed to purchase the vehicle from yourself. You self-finance that purchase. Well, the beauty is that because of that participating loan feature, that $40,000, unlike the cash scenario, is still working for you inside of your policy. It's still growing and compounding, earning compound interest inside of the policy. So the interest you earn on that $40,000 over time is going to look something like this. It's going to grow on a compound interest curve. On the other hand, you took out a policy loan against your cash value for $40,000 to self-finance the purchase of that vehicle. Well, these policy loans are calculated with simple interest. So every time you make a repayment towards that policy loan, the principal balance is reduced and the interest that you owe is also reduced. And so over time, as you make repayments, the total amount of interest you pay looks something like this. And so what happens is that, by self-financing the purchase of this vehicle, you took out a $40,000 policy loan against the cash value in your infinite banking policy. You paid interest on the repayment of that loan over time. That was the sum of this bottom curve here. But that same $40,000 was still working for you inside of your policy, growing uninterrupted compound interest reflected in the top curve here. So essentially, you've created this arbitrage spread of interest earned on the top curve versus interest paid on the bottom curve. And you effectively made money by self-financing the purchase of that vehicle and effectively operating as your own bank. And so that, in a nutshell, is where all of the magic happens. It's through that participating loan feature and effectively allowing you to use your dollar twice. That $40,000 went to purchase the vehicle, but that same $40,000 was still growing and earning interest for you and compounding uninterrupted inside of the policy. And so you're taking advantage and capturing this arbitrage spread of interest earned versus interest paid. And so again, effectively acting as your own bank. And that's really where the beauty happens in this whole strategy. So just to kind of further dive into some numbers, I've created a spreadsheet here that just kind of simply shows the power of this strategy. So let's plug some numbers in here. Let's use the same scenario here and assume we take out a $40,000 policy loan to buy a vehicle. let's say the interest rate on the policy loan is 5%, which is that's going to be a function of the current market interest rate. So that can be that interest rate can vary, but typically it's going to be in that kind of 4 to 5% range. And then let's just say inside of the policy, so inside of your whole life insurance infinite banking policy, you're also earning 5% on your cash value. So those interest rates are identical. And then let's look at the loan repayment. So the $40,000 that you borrowed here, again, the repayment terms are completely up to you. So let's just say you elected to make repayment in the form of, let's say, $600 per month. So in the blue columns here, I've calculated the interest that you're going to pay on the policy loan, and in the green columns, we show the interest that you're earning on that same $40,000 inside of your policy. So if we scroll down here to see when you finally pay off the loan here, this column is the principal balance on the loan here. So you see it goes from positive to negative here in month 79, so just under 7 years. So let's kind of focus on this row here. This is where you would have paid off completely the policy loan. Actually, in month 78, or in month 79 rather, you would make a payment for $157 and you'd have the policy loan completely paid off. But let's look here at that first month after the loan's paid off. So you paid a total cumulative interest on the policy loan of just under $7,000 on that total $40,000 that you borrowed against your cash value. That same $40,000 through the participating loan feature was still growing and compounding for you inside of the policy. And look at that same $40,000 earned you in interest inside of the policy, over $15,000. So if we look at the difference, which is calculated in this far right column, you effectively made almost $8,600, so made over $8,000 by self-financing the purchase of this vehicle. And again, going back to our graph here, that is this arbitrage spread that you were able to capture by operating as your own bank. You paid under $7,000 in interest on the $40,000 you borrowed, but that same $40,000 earned you over $15,000 of interest inside of the policy, even though they were at identical interest rates. And that's because the policy loan is simple interest, and every time you make a repayment, that principal balance is reduced and the interest that you owe is reduced. So the sum of that interest that you paid on the policy loan was less than that cumulative interest that you earned that was compounding inside of your policy. And I want to show you one more thing here. And it's really that, let's say you didn't want to repay the policy loan at all. So I'm going to select 0 here as our loan repayment. So you can see here in this column, I'm not paying any principal towards my policy loan. I'm not reducing that principal balance. So if I scroll down here, I think we've drug this out to 10 years. Yeah, 120 months here. So over that 10-year period, the $40,000 loan, it's just simple interest. So essentially at 5%, I'm stacking $2,000 a year on top of my balance every year. So I would have racked up a $20,000 bill of interest on the policy loan, but that same $40,000, because it's compounding interest inside of my policy, earned me almost $26,000 inside of the policy. So I never made 1 penny of repayment on that loan, but 10 years into this, I'm still almost $6,000 better off because I used this concept and my own money to self-finance the purchase of the vehicle, even though I never repaid the loan. So anyway, hopefully that helps kind of illustrate the power of this strategy. But again, getting back to really the kind of nuts and bolts of what makes it so great is it all goes back to that participating loan feature and giving you the ability to, quote unquote, use your dollar twice, use your cash value to borrow against and pay for purchases or investments, while simultaneously still allowing that money to grow and compound inside of your policy. And I should also say, in this example, we've talked about the purchase of a vehicle. This can be applicable to literally anything. So this could be, again, college tuition for your kid. It could be a vacation. It could be a down payment for a new home. It could be improving a rate of return on an investment you make. So let's say you took the same $40,000 and you used it for a down payment on a rental property, on a real estate property. Well, this arbitrage of your money is still working exactly the same way. So, if we scroll down to the repayment period here, as we mentioned, you're still effectively improving your total rate of return on your investment by over $8,000 because you self-financed that investment using your infinite banking policy. So anyway, hopefully that makes sense. Hopefully, that kind of shows you the power of infinite banking and how these specialized types of whole life insurance policies can be used in a very dynamic way to provide a lot of different benefits. Again, kind of going up here, the fact that it's all completely tax-free, the IRS can't take any of those dollars, not the principal contributions, not any of the gains or the growth, the death benefit if you were to pass away. That is all completely tax-free. There are no restrictions whatsoever. It doesn't matter how much money you make. It doesn't matter how much money you put into these policies. There are no restrictions. You can access your cash value anytime you want it for literally anything you want. The money is typically accessible after just 30 days. So you could take out a policy and literally 30 days later, you could start borrowing against it. To essentially operate as your own bank. And again, going back to our graph, capturing this arbitrage spread of interest earned versus interest paid to essentially make money, saving money on interest or improving your rate of return on investments by operating as your own bank. So hopefully that makes sense and helps you kind of see the tremendous power of this strategy. If you've got any questions at all, here's my contact information. Again, my name is Nathan Sprague with Guardian Financial Group. Please feel free to call or text me at this number or shoot me an email at this email address here, and I'd be happy to answer any questions you might have. And it's pretty easy for us to put together an IBC design and illustration to show you kind of exactly what these numbers could look like for you, and can go from there. So hopefully you found this informative. Thanks for watching, and have a great day.